Good morning, you beautiful people. My name is Andrej, and today we're going to be talking about a leading AI company in China that is ahead of Google, Tesla, and a lot of these other AI companies. So even if you are scared of investing in China, in this video, you're going to learn a lot and how I believe United States will implement their AI and their robotaxis in the United States. So in this video, we're going to break down the three business segments that Baidu has. Apollo Go, which is the robotaxi autonomous driving section, AI, and iQIYI, which is kind of a Netflix subscription. So Baidu is known as the Google of China because it holds the biggest search engine in China. It holds more than 90% of the market share in China. So it is as dominant as Google is in the United States. And the thing is, all these companies like Google, Meta, Amazon, they're not implemented in China. China is protecting their own economy. And China is the second biggest economy that is growing 3 times faster than America. So it makes no sense if you don't diversify your investments into China as well, at least a part. So before we get into any evaluations or we look at their margins, let's take a look at their business first and understand it. So the one reason I think Michael Burry, the man who called the 2008 short, has over almost 12% of his portfolio into this one stock, Baidu. So one of the main reasons I believe is Apollo Go. Apollo Go is the robo-taxi program they have. They started in 2020, and since then, right now, they have 500 active robo-taxis in fleet in over 10 different cities. In 2022, they announced their sixth generation vehicle, RT6, that they built from the ground up with three crucial partnerships they made. One with BlackBerry for the software, mapping, whatnot, and two automotive companies. One is Geely and one is Yanling Motors. So RT6 is a fully electric vehicle, an EV that has 360 cameras inside and outside and has been in no crashes, has done over 3 million trips already in the 10 different cities that they are in. The key things about the RT6 is it costs 50% less than their previous generation Apollo Moon. So the RT6 cost them about $37,000 to build when the Apollo Moon cost them $69,000. That's a huge difference, and it's going to be way easier for them to scale at this lower price. And RT6 also costs 1/10 of the industry level 4 autonomous vehicle, which it is. That means that these robotaxis could potentially be half the price of a regular taxi. Right now, they do have a fleet of 500 vehicles and it projected to be 1,000 by the end of the year. They currently are not profitable, but they are set to be profitable by 2025. Not the whole company is profitable, but Apollo Go, that revenue segment. Some of the things you should keep in mind is that they are already in 10 cities, like Wuhan, Beijing, and Shenzhen, which are massive, massive cities. And by 2025, they will be in 65 cities, and by 2030, they will be in over 100 cities across China. Now, some of the main things to keep in mind is their competitors. Of course, there's Pony AI, which is another Chinese company that has a fleet of 250 vehicles in China. Now, the thing is, you might think, how does this compare to Tesla? They do have quite a different business model. So their robotaxis are not for sale for individual consumers. They build them themselves and they use them themselves just for the robotaxi purposes. On the other side, Tesla, there's millions of Teslas out there. I see them all around in my city, and I bet you do too. The thing is, this is a software thing. Tesla's model is that all of their Teslas, they will build a program, the software that lets them rent it out as a robotaxi. So that is a whole different company, whole different economy, and I'm very bullish on Tesla as well, even though I do not hold any stock personally. They did also openly say that they are open to help Tesla with their self-driving programs. So these guys are one of the first people to do it, to have robotaxis active and around the city. Now, the reality is it's far from perfect. Right now, most of their robotaxis do have a driver assistant that doesn't actually do anything, but is just in the driver's seat in case something happens. There's also, like we said, cameras inside, outside. There's an SOS button that you can press if anything does go wrong. And if you have an emergency and you're driving to one destination, you can just on your phone change the destination to where you need to go and it will take you there. All right, guys, there's two more things we have to break down. First is iQIYI, and then we have the AI, which is the big deal. That's the fastest growing segment, growing 14% year over year. But what is iQIYI? iQIYI is pretty much their version of Netflix. They have 100 million subscribers right now versus Netflix, who has 260 million subscribers. But the thing is, iQIYI has a free version. You can watch anything you want at 720p quality instead of 4K or 1080, and you also get ads. So with these free subscribers, they also have revenue coming in. We just don't know how many there are. iQIYI had a slight year-over-year drop of 4% in subscribers. They're still investing in it. We can see right here that they released 300 new titles in 2024, and it is gaining popularity in East Asia. This platform can be used anywhere in the world. You can watch it as a Canadian, as an American, in Europe, wherever you want. All right, now let's finally talk about their AI. AIs like ChatGPT aren't allowed in China. So Baidu has their own Ernie bot. Ernie bot 4.0 is the latest version they have released. And we can see right here that they have surpassed 200 million users as of April 2024, doubling from 100 million users in 2023. So it's growing very rapidly. They have 85,000 businesses using this AI. And one of the key partnerships they have is with Fanhua. Fanhua is an insurance company, the biggest insurance company in China. And we can see that they're excited about their partnership with Baidu. Envisioning the future insurance market, we firmly believe that AI robots will become the most proficient independent brokers. Fanhua and Baidu will join hands to usher the insurance industry into a new era, achieving leaps in productivity and efficiency. So, in simple terms, they're going to use this as an independent broker. Instead of calling a person who doesn't have all the information and can't get it to you very quickly, this AI will pick up the phone and they will know everything you need. The implications of this AI and any AI is endless. For example, here are some of the jobs that they will be taking, such as graphic design and warehouse jobs. Ernie Bot has customer support. So that's one of the things they will be doing for their insurance company. Customer support. We can see right here that it improved customer satisfaction by providing quick and accurate responses around the clock. Content creation. So businesses use it for marketing campaigns, for creating pictures and ads. E-commerce, of course, e-commerce because AI can take care of and track all the inventory businesses have and continuously order more when they are out. Data processing analysis, virtual assistant. If you didn't know, up until now that AI came out, people would hire virtual assistants, people who would do things like data, marketing, and all these things, setting routines and schedules. Now, let's take a look at how their business is performing and how it's projected to grow. We'll give it a rating out of 100. But first, let's take a look at some of the main things. We can see the gross margin is 50%. It's okay. Net margin is 14%, which is pretty good. That's the same as Alibaba's and even better than Amazon's of 7%. We can see some of the things. We can see that the next year projected earnings per share is 1200%. The next year revenue projection is 15%, which is much better than the 5% that they grew this year. And we can see it's only selling for a PE of 15. And if you do a PEG, which you divide the current price to earnings compared to the earnings growth projection, we get a PEG of 0.01, which just means it's just way too undervalued. Now, for the ratings, revenue, I gave it a 0 out of 10 because they only grew 5%, which is going to change by 15% in next year. Net profit margin, 14%. That's pretty good. I gave it a 10 for that. Cash increased 11% over the last year. They have 2.3 times more assets than they do liabilities. They have 1.8 times more cash than they do current debt. Short interest. So out of the float, only 3% of the shares are being shorted. So not too many people are betting on the stock to go down. Usual is I look for under 5%, so I gave it a 10. Institutional holdings 0. You want institutional holdings to be at least 50%, which means institutions are bullish on the stock and are investing in it. Now the problem is just because it is a Chinese stock, a lot of institutions are already out. Scalability and industry. You should have 100 out of 10 right here. So robotaxi AI, some of the fastest growing things. Keep in mind, AI is one of the fastest growing industries, growing at a CAGR of 36%, but in China it's growing at a 46.5%. So most industries are growing much faster in China, and so is the GDP growing much faster, and it has a lot more people. Return on assets only 5%, so I gave it a 5. But I think the management is right now building the infrastructure for all these segments like AI and robotaxi to be way more profitable and do far better in the future than they are right now. And of course, PE is 14. That's pretty good. I gave it a 10. No companies that are growing this fast have a PE of 15. So altogether, it did only score 75 out of 100. But I believe if you take a look at this stock with the same metrics next year, it'll score 90 out of 100. No, the key thing is let's see if it's still cheap. This stock right now is trading for the same price it was in 2010, 14 years ago. Even with the 30% spike it had in the last month, it is still trading dirt cheap. If you look at the price to book value, price to sales, price to free cash flow, it is just cheap. If you look at the averages, the average price to book value was 3.4, it's sitting at 1.1. It can go up 3 times the current stock price just to reach the average price to book value. Free cash flow usually trades at 26. Right now it's trading 8 times free cash flow. Microsoft is trading 40 times free cash flow. If you look at price to sales, usually trades 4.6% cash, 4.6 times cash flow, currently trading at 2 times cash flow. The last thing I want to mention is that they do have a share repurchasing program, which is a bullish sign because we know the insiders think the stock is cheap, so they're buying back shares. I hope you enjoyed this video. And if you have any questions, please comment down below. And if you enjoyed this type style of video, subscribe because there will be more. If you're interested in learning more about the Chinese economy and the best Chinese stocks to own, I did make a video on the best Chinese ETFs, which talk about why China is such a good investment opportunity right now and a bunch of ETFs that you can diversify your portfolio into. Thank you very much for watching, and I'll see you in the next one. Have a great day.